Okay, we are live. So, welcome everyone to the PitchIt interview series. I'm your host, Todd Anderson, Chief Product Officer at Lendit. We have two special guests with us today with the Latin American Lendit FinTech Latam event around the corner next week. We wanted to bring in a couple of founders to talk about, what's the evolution of the fintech ecosystem been like in Latam. Clearly, today it's become one of the hottest markets in the world, but it obviously didn't start that way. And so we want to talk to two founders who've been there, from the beginning and kind of have ridden the wave in different ways. They both are, angel and investors today, so they're putting money back into the ecosystem. And so we want to talk to them a little bit about where the evolution has gone and also what's coming up next. So without further ado, let me just first introduce our guests. Ben, we'll go with you first. If you could tell the audience a little bit about yourself and Guiabolso.
Cool. And I'm originally from the U.S., which was actually, we'll talk probably a little bit about that, but pretty common back in the day. A lot of the early entrepreneurs were from outside of LATAM. But worked in the U.S., Brazil, and Europe, and then did an MBA. Came down with McKinsey to Brazil, 2007, so quite a ways back, and then ended up starting to kind of the startup journey with Groupon here during the explosion of the daily deal space. After the IPO, left to found Guiabolso in 2012 together with my co-founder Thiago, basically to take on the challenge of personal finance and getting people access to better products. And one of the things back in the day in 2012, as we were putting together our pitch, we had to do like financial technology and then in quotes say fintech and explain to people what fintech was. And so it was like very, very early in the space, but kind of over the last 9.5 years, built up Guiabolso to be kind of the leading personal finance platform, and then the pioneer in open banking and driving a lot of the open banking regulation and market here in Brazil. And then we ended up exiting earlier this year, and now back with another new fintech. So doing it again here with a fintech called Camino, which is taking on some of the frictions that kind of we felt along the way in terms of just the overall financial infrastructure that fast growth companies face in LATAM.
All right, and Brian, over to you. Tell the audience a little bit about yourself.
Sure. So I'm from the Bay Area originally. I got in my car and I drove from California to Costa Rica, bought a one-way ticket to Bogota, Colombia. Similar to Ben, there's a woman behind these stories. So my wife is Colombian. She likes to say she imported me to Colombia. While I was living in Colombia, I ended up, coming across a case study from Mercado Libre, and I'd had a terrible experience finding a property. And so, kind of put those two together and ended up building VivaReal, which is a prop tech company that basically aggregated and centralized all of the real estate data in Brazil. I was in Colombia, but I studied the market and I saw Brazil was a much larger opportunity. So in 2011, I picked up and headed to Brazil, and we built the business there, bootstrapped, and eventually raised a bunch of VC. That business scaled, and we merged with a competitor, and then we exited the business last year in an all-cash deal where OLX, Naspers, a joint venture between Naspers and another company, bought it. And so, like Ben, I've been angel investing, and fintech obviously is at the core of LATAM, and we'll talk about that a little bit. But now I'm building Latitude, which basically is providing infrastructure and community to solve problems for early stage founders. And so we can talk a little bit about that as well, but happy to be here.
So my first question really is, and Brian, I'll stick to you on the first one, and then we'll go to Ben. How much has evolved, say the last 10 years in LATAM? Today, obviously, we see some companies, hundreds of millions of dollars, Series A, and even angel rounds are significantly bigger than they were even just 3 or 4 years ago for LATAM founders. So kind of what has that evolution looked like?
I remember several years ago sitting in Mickey Malka's office. Mickey Malka, as many of you know, the founder of Ribbit Capital, a large fintech investor globally. And he's like, Brian, where are the exits? Where are the exits? He said that to me. And, I was, at the time, I had invested in a company called La House, which is, kind of prop tech, but has some kind of fintech pieces. And, I remember, telling him, hey, this is going to happen. It's, and he, it's something that, 4 or 5 years ago, we just didn't have the volume of exits. So I think Ben will attest to the desert that we experienced. I think Eric from Monashis calls it the nuclear winter for like a decade, and then kind of wheels got in motion, and a subsequent kind of series of events. I think that if we look in recent times, the SoftBank kind of arrival and that $5 billion kind of stake in the ground was definitely a monumental shift. But speaking more specifically about fintech is the gateway drug for global investors to invest in Latin America. So I think that a lot has accelerated with a handful of successful companies that have paved the way, and it doesn't seem so foreign to people outside of Latin America that, hey, this might be a region that I should be investing in when you look at the likes of Mercado Libre, Nubank, Rappi, and others.
And Ben, same question to you.
Yeah, and I think that's totally part of it, because when you have almost no exits, when the exits you do have are small, as an investor, you feel like you don't want to make any misses, and so people were much more, I think, concerned about making a wrong investment than about missing a good investment. Whereas nowadays that's flipped on its head, and so I think that's part of the reasons that people are able to put more money in more quickly, just because they don't want to miss the good deals, because they do see that there's that additional upside. And I think the other big thing that we saw as we were starting out is that this was 2012. Brazil had gone from kind of a lot of banks down to 7 banks, then went down to 5 banks, and everyone still thought that the advantage was in the branch network and that it was still kind of an offline business. I think really the increase in the penetration of smartphones changed the game a lot, and so that's certainly what we saw, and the banks were not very well prepared for that, and that's what opened up a lot of access directly to consumers or directly to small businesses for all the fintechs that came in. And I think the other big thing that we feel is just at the time we had to build almost everything from scratch. So even like all the enablers, all the layers of software or anything that we wanted to do, we had to build completely on our own, just because the global players didn't have any traction here. And now we do see that they're banking as a service providers. There's a whole series of kind of underlying infrastructure providers. Many of them are still very 1.0, but at least they exist nowadays. They didn't even exist back in the day, and so people can focus on actually their core business and kind of creating a specific value proposition, as opposed to kind of doing a lot of the back office systems just to get the product to market.
I would add one additional thing, which is talent, right? The gaping hole is that there wasn't a level of interest to join startups, right? When we both started in the early days, it was difficult to recruit people. If they were making a ton of money in banking or in consulting, why leave and join this, what was seen as a perceived risky opportunity? And that has, kind of also inverted. And now people are like, why would I work at a bank or, at a traditional, consulting firm, when maybe it makes sense to join for a few years, but I have a lot more growth potential in a fast moving startup. And so I'd say that compounds with the capital, enabled that. And then all of a sudden people realize that they can have lucrative careers building companies and joining startups rather than working for, kind of corporate entities.
What are, Ben, I'll go to you first on this. What are a couple of the lessons that, that you learned, along the way that, if another founder listening to this, whether, the live version or when we package it for the podcast, that, you might be able to talk about that, they can learn a little bit from?
Yeah, I mean, I think one thing that we saw early on is that people underestimated the need to, kind of study the regulations and understand the regulations and have a proactive presence. Discussing with the central bank, which is actually in just particularly in Brazil, is amazingly open and kind of an example to the world these days in terms of the very proactive kind of pro competition and pro digital regulation that they're bringing forward. And so I think that's the first piece, is you can't underestimate it. I think in general in Latam, if you come in, you start saying we're going to disrupt the financial system, that's going to raise a lot of red flags. So very different than Silicon Valley. And so take that seriously. And I think the other thing is that the credibility is still tied to a lot of traditional players, traditional figures here, and everything else. And so it also does help, especially for founders coming in oftentimes from outside to get to know the ecosystem and to in some ways either bring in advisors or bring in investors that kind of have been around the block, have seen things that have gone well and that haven't gone well. Because it's the typical kind of I'm going to be whatever the Uber for whatever, and just bringing something from the U.S. down to Latam has traditionally not worked, and so you do need to understand kind of the local realities and adapt the product. And so I think that's also something which is critical for people to like come be on the ground here. You can't do it remotely and really kind of live the problem and then try to solve it.
Yeah, just adding to that last point, I think that if you're early in your process, constructing your cap table in a way that, the way I thought about VivaReal was finding people that had operated and executed maybe in other markets or that had some expertise in the sector, and then also people that could help with stage financing, along the way as you scale your company. So I think constructing the cap table in a way that allows you to kind of have a step function of accelerating your journey and having people join you on the journey that can help you achieve your next milestones. And then I think that kind of tangentially to that, I would say that it's a lonely journey, right? It's a hard journey. Ben and I both know, the difficulties of building a company. And so finding your kind of community of people that can help you. When I was, building VivaReal in Brazil, I didn't know a lot of people. I didn't have a lot of friends initially. And I found a huge support in other founders that were maybe one or two steps ahead of me, or just kind of at the same stage as me. So we formed a little group of founders. We called it the Breakfast Club. There were a handful of other successful founders that were at different stages, and then we ended up helping each other. And there's a lot of like things that you learn along the way, or expertise that Ben might have that that I don't have. And so when you develop that kind of community oriented, and you realize that the rising tide lifts all boats, you put yourself in a position to succeed. And we all succeed if Latin America grows as a whole, because the entire market size grows, and then that's ultimately something that benefits everybody.
How much in that type, to pick up on that point, how much, I guess, could a competitive dynamic potentially hurt that grouping of founders? Because ultimately, as the ecosystem grows, there's going to be companies that become similar to one another, yet the ecosystem needs to continue to grow. So how does that work over time? Or does it not work? Do you want
to go, Ben? This is like a perfect question for Ben and I, because we're actually building something super similar, and like we're probably going to be competitors, which is hilarious. But I took a due diligence call on Ben yesterday, and I was super complimentary of Ben, even though we're probably going to build some things that are going to overlap. And so, I shared that with Ben, and Ben sent me back a message, which I really appreciated, which was, that there's the mentality of kind of like, not stepping on people versus, you might have short-term gains, but the reality is that your reputation is like something that you build over decades, right? And so you don't really benefit from bad-mouthing somebody or not being a supportive person. And ultimately, the world is pretty big and the opportunities are abundant. And so if you kind of have the right, and this is just a personal philosophy that I have, like that I've kind of tried to live my life as being someone that's an elevator versus, crabs in a bucket, where it's like, oh, these crabs want to get out of the bucket. One crab gets up and then the other crab latches onto the back and pulls it down. No one gets out of the bucket. And so that's one of the reasons why I built Latitude, is this community-driven focus where, but yeah, I would be naive if I didn't say that there's moments where it's kind of hard and you've got to figure out how to navigate. But I think that, that's been my personal philosophy. And Ben and I have been friends before we were, potentially building something similar. And so I like to preserve that, over short-term wins or stepping on other people.
And I also, just as a rule of thumb, if it's two startups, fighting each other for this market, it's probably not a very big market. So, in a sense, either you need to take market share away from incumbents, or you need to expand the size of the market, because if it's otherwise it's just probably way too small. And so I think that's the other piece. And in a sense, open banking, for example, there's a bunch of players coming in and saying they're doing open banking. if the size of the market, of buyers of open banking solutions doesn't increase, it's not going to be a big business, right? So ultimately, you need hopefully a number of players that are credible that can actually provide real solutions that add value. Therefore, forcing other players in the market to also consume open banking services. Because if the first few screwed up because they're so busy fighting each other, then ultimately you might kill the market. And so I also look at it that way as how do you increase the overall market size? Because most of the time it's way under penetrated still in Latam, and that's where the opportunity comes from.
Yeah, there's not a shortage of problems to solve in Latin America either, right? So to Ben's point about importing ideas from the US or other places, like, I think that we both realize that solving for local problems is the opportunity, and you can't just always import, what's outside of Brazil or Mexico or wherever. And so, probably certain companies like Ben and I are on our journey might start in a similar fashion because we see a common problem, but there's no shortage of things that I see as opportunities. And so to Ben's point, if you focus on the abundance of problems that you can solve and not on your competitors, you ultimately will have a plenty large of addressable market because, as I said, there's no shortage of challenges in the region.
And actually, funny story. In I think 2013, we heard about this guy in the market in Brazil, like ex-consultant, a Spanish guy, and from our understanding, he was doing the exact same thing that we were planning to do. So we're like, oh man, like this is gonna be bad. And when we ended up kind of sitting down with him, and the first thing he said was, "Hey, you guys just try to steal my CTO," and it was Sergio Furio from Creditas, and we kind of hit it off, and then we like, okay, let's collaborate on certain things. And every time we'd see him, he'd be like, okay, what's your conversion rate? My conversion rate is X, and it's this funny thing where we thought we were going to be potentially competitors, but he was always so much like, let's share information. And then he went completely different direction from Guiabolso and has an awesome business in secured lending, which wasn't even on his radar at all in 2013. And so to Brian's point, I think that's the same thing, right? If you're focused on the problem and focused on following your customers, you never know where it's going to go. And it's the PowerPoint is it's always going to have overlap because we've talked to a bunch of funds and they're like, oh, like everyone in the space says they're going to like dominate whatever the SMB market, but ultimately it's also like if you were to look at back in the day, okay, new bank seems to be doing well, therefore I'm not going to invest in any personal digital banks beyond no bank. You would have missed a whole series of other banks that are doing super well. So definitely big markets once they get going.
So you've both raised money. You're both investors now. How much has changed in the the kind of the funding landscape, the funding conversations from when you started to what they are today? From the outside looking in, it seems like there's just an abundance of capital. A lot of things can get funded. Big U.S. funds have gone down to Latam, opened up shops, hired local people, and are just flooding the market with capital. Obviously, raising money is not easy in any sense, but kind of how has that changed over the years from when you started to those conversations that you're having today?
Well, you don't have to beg investors anymore if you're if you're credible and you've got an interesting idea. No, in all seriousness, if I look at the decade ago when in the early days when we were raising a seed round or a Series A, obviously there's a handful of differences, right? The sizes are different, the round sizes. It's the classic kind of like what used to be Series B is now Series A, and what was Series A is now. It's like that's you can literally just like draw an example of that over the last kind of 5 to 10 years, where things have just moved up and the dollar amounts have gotten bigger, valuations have gone up, but rightfully so because the values of the companies have gone up and the markets have gotten bigger and all those things. So I think that the other thing that's a huge boon for the ecosystem is that there's more angel investors than there used to be, right? So when I started, I was very fortunate, besides like hosting a donut for 2 years and not being able to raise money, from like 2009 to 2011, and finally, tipping the scale on who would invest. It all cracked wide open when I found a handful of really good angel investors. These happened to be international folks because there wasn't much of a local angel investor community, but they ended up bringing other people in. So I ended up raising money from Mickey Malka as an angel, before he had Rivet, and making that focus. Wences Casares. So like these are former entrepreneurs, but there was literally, you could count them on, your hands, right? And so now if you take that and you extrapolate out to where we are today, there's hundreds, thousands of potential investors, and many of them have had success. And so, and not only are they, there's more liquidity in the market, but that check comes with some expertise and some knowledge that can be, imparted on the founders, which, Ben and I have both co-invested in a handful of things together. I have a small fund. He's an investor in my fund. So there's all kinds of crossover there. And I think that there's more of a networked community that, wants to support the founders also, not with just money, but with advice.
Yeah, and I think the other thing too is, back in the day, it was really adverse selection for a lot of the local investors, but they could get away with it because there's no other capital, and so they, you'd hear investors say things like, "I like to, study the market for 6 months and then dig into a company for another 6 months and then make a decision to invest or not," which is horrible for a founder. Or they try to like do these, in tranches. I'm going to pay you if you hit these, milestones and all that kind of stuff which is bad. And even the accelerators, the early accelerators, many of them failed because they were extracting, too much equity for too little capital and too little actually, boosting up the companies. And back in the day, we had what we called startup mansion, and so there were just a group, kind of like Brian was saying, a group of startups at the same stage decided to all be in this big house together, but there was no accelerator or no equity. It was just renting a place and being able to bounce ideas off of people. And that probably was the most successful cohort of startups in all of Brazil compared to any of the accelerators, just because you actually had a place that wasn't taking equity but was adding value to early stage founders. And so I think that's the biggest thing nowadays is people know that they have to be, they have to go much faster. They have to actually add value. They have to, give clean term sheets, because otherwise they create adverse selection and they don't get good deals. So I think that's great for the ecosystem and definitely for the founders.
It's one of the reasons why at Latitude we actually we run cohorts of founders, all remote, and we also have cohorts for investors too, which Ben participated in the investor, the angel investor fellowship that we launched just recently. But instead of taking equity, you get all the benefits of like business school where you have a network and there's knowledge and advice. So you decouple the capital from advice and network. And as to Ben's point, the adverse selection is real. If you launch an accelerator in Latin America and you don't have like a huge brand, you're probably going to not attract the top founders. And so it was one of the reasons why at Latitude we decided to not take equity in the companies, and it kept the bar really high on who applied. And so that's something that I think more initiatives like that will foment the ecosystem even more.
What advice would you give to a current founder raising capital for the first time?
Yeah, I mean, I think the main thing I always, although I'm an angel investor, I basically, I'm always founder first, is I'm trying to help them maximize the terms and everything else. And it's really, it's ultimately comes down to supply and demand. So assuming you check the boxes for a good team, big problem in all of that. It's supply and demand. And so it's really, getting out, meeting a lot of investors, talking to a lot of people, taking feedback, before you're pitching, and then incorporating that. And when you go out, really going out, in a very structured way and talking to as many people as possible, and choosing, hopefully the investors that are going to add value. Because I think that's the other piece. If you try to early days optimize, for valuation or reduce your dilution independent of who the investors are, you're going to suffer for the next 5 or 10 years potentially with not great people on your cap table. And so oftentimes really great investors can add more value even at a worse terms initially. And so kind of weighing all of that, and that's the biggest thing that I look to. And as we're going back out to the market now, it's just I can't even believe almost 10 years later raising money again. And talking to investors, in the old days, it was like, okay, there's 5 investors we can talk to. And now people are like, oh, I got 5 term sheets. So it's definitely like, just kind of gone exponential. And but that means that I think the founder has to work harder to really filter out, who are the right investors for the business.
Yeah, I'll add to that, or maybe expand on it a little bit. I think I agree. The volume of investors. What we like to think about at Latitude is that we think of what one of our mentors, Jason Ye, calls calendar density. So if you go in, you make a massive list of potential investors, you should be organizing that based on ensuring that they're the right stage investor and the right check size and all those things, so that you don't waste a bunch of time. So matching the profile of the investor based on the sector. Do your research to make sure that they've already invested in the sector, or they like this sector and they like the check size, all that stuff. Then you organize in a highly dense period of time where it's back-to-back meetings. The reason why you do that is because oftentimes founders will have one-off conversations and then they'll be advanced with this other investor here, but you need competitive dynamics. That's how you get the best terms, and that's how you. So adding to that, in terms of the amount of money to raise, this is another thing. And here's some advice for some very early stage founders. Oftentimes, if you can, let's say you're raising a $2 million seed round, sometimes it makes sense to go out and raise, that in two parts, and you raise $500,000 at a certain cap. Maybe it's on the lower side. You reward for those early, people that, might, make a move quickly, and that can send a positive signal and maybe introduce you to other investors. And, then you can walk the cap up. If you go out to the market and you try to raise 500,000 versus 2 million, if you raise 2 million and you don't get the same feedback, you might be pricing the cap too high. And so this is a way to kind of, hedge a little bit and also create momentum, because this is a very momentum-driven process. And if you go to the market and you have a huge ask and then you don't get action on that, going back and doing that again is very difficult. It's just like there's question marks, like, why didn't it happen? And so these are some strategies that I think make sense. So you can walk your cap up as you get more demand. And I'd say those are the other tactical thing is, if you have a list and you have a comprehensive list of, let's say, 30 investors, internally, why don't you rank those on who you would really love to have, and go to them last, because your muscle on the fundraising side will be more kind of prepared towards the end of the cycle in that kind of calendar density, because you'll already have done a ton of pitches and you'll be tighter. You'll have listened to the feedback and see how investors respond, adjust your pitch, and then you'll be sharper when you get to your tier one desired investor. And so that's something that I think I've seen founders have a lot of success with.
So we have just a couple of minutes left here. So I want to end with, kind of, what do you guys think is next, in LATAM? Clearly there's been a lot of shift the last decade that you guys have seen. Is there another big shift coming? I mean, has, the impact of COVID taken digital financial services and kind of ratcheted it up? What are your thoughts for the next few years in the space?
Yeah, I mean, I think a couple of things, right? So just in terms of macro trends, open banking, and then a lot of this kind of open finance on the payment side is going to be really impactful. So I think if there's going to be a lot of kind of solutions and markets that are being created as it's getting increasingly easy to get access to information and have the money flowing and following the financial products being created. And so that's something that I'm very bullish about. It's going to take a little bit of time, but I do think that there's going to unlock a ton of value and a ton of new products that are better for consumers ultimately, but also better for the product providers. So I think that's one thing that I'm excited about. The other thing is obviously the infrastructure plays, right? So it's like in the gold rush, at some point the guy selling the picks and shovels has a really good business. And so just like in the US, when we started back in the day, actually we all the B2C companies were super hot. The fintech B2C companies were like all the investors were loving B2C. We went to talk to the guys from Plaid, and they're like, yeah, it's hard. And then 5-6 years later, Plaid is one of the hottest companies around, and all the investors love B2B infrastructure plays. And so I think that it starts to catch up as you have a critical demand or a critical mass of companies that can actually consume those services. And so that's something also that with Camino also we're doubling down on that, is saying how can we actually help to accelerate even more the incredible boom and all the capital coming in, which is basically by creating much better rails for companies that start operating and running their expenses through and being able to actually deploy all the capital that they're raising in a more efficient way so they can focus on their business, because that's definitely something I remember in the early days, we heard a founder from Silicon Valley say that he spent 50% of his time on company culture, And I was joking, like I probably spent 50% of my time at like, on bureaucracy and, down at the notary public and, trying to talk to my bank so that I can get a credit card. And so that's, such a wasted time. And so the more that, companies are coming up and reducing some of the bureaucracy and, it lets founders actually focus on things which are relevant to their business and to their company.
Yeah, I'll echo that. In one of our first cohorts, we had Pomelo, which was doing banking as a service, and we were fortunate to write the first check into that company, which has subsequently raised significant capital, and they're solving a big pain point, which is as Angela Strange said, I think that every company will become a fintech, and that's an enabler for that. Banking as a service. And
they'll be speaking next week as well at our event.
Oh, good. Yeah. Gaston and the whole team there is fantastic. But I think that to kind of piggyback Ben's comment on the infrastructure piece, there's things that you take for granted in the U.S. For example, creating a company it's a very painful process in Latin America. Opening a bank account, all those things are very difficult for startups, and they end up spending all this time on that. In my case, I ended up creating the wrong corporate structure. We ended up losing $100 million of enterprise value upon exit because we had the wrong corporate structure. And if you do it correctly, you need to hire one of these, global law firms and pay them $30,000 to make sure that you're set up the right way. And so one of the products that we recently launched is called Latitude Go, where we automate the entire company formation process. And so that's an example of infrastructure that I think is necessary. And I think that there's a massive opportunity to build the rails, for the next generation of companies. And then lastly, I'll say another trend, which I'm not an expert on, but I definitely, as I go deeper down the rabbit hole and read the white papers on Web3 and just, crypto in general, like that's a whole nother kind of arena of opportunities that gets me excited. And I have that feeling like I'm late to it, but then I realize that like it's still being created and it's still early. So I would say those two things I definitely echo Ben's statement around the infrastructure piece, and then maybe new infrastructure also, built on an entirely different decentralized, platform. So the whole region is just full of opportunities. That's why there's so much excitement. And I think different than 10 years ago when it was just Ben and I and a handful of like people starting out, the caliber and this vintage of founders starting now, dreaming much bigger, way more equipped and sophisticated around building a company. So if I had to, predict the next 10 years, I'm very bullish on LATAM as an opportunity. And that's why I'm kind of dedicating the next 10 to 20 years to help building the ecosystem.
Well, I think that's a perfect place to end, Brian. Ben, I greatly appreciate you spending a few minutes with me. Thank you. And to the audience, we'll see you next week at our event in Miami. So thanks again, guys. And thank you to the audience.
Thanks, Ben. Thank you, Todd.
Great to be here.
All right. Bye.
See ya.